Good evening and welcome to Plant Your Seed. On today's episode, we're continuing with the theme of controlling your money as we have for the past couple of weeks. On today's show, we're introducing the CEO of Rwanda Stock Exchange as we discuss the issue of compounding. We will cover how accessible the stock market is for the average Rwandan today and how we can start making use of the compound effect through the stock market. Once again, we're speaking with the CEO at Rwanda Stock Exchange, Mr. Pierre Celestin Rwabukumba. Thank you for being on the show.
Thank you.
Today we're discussing, again, in the context of controlling your money, what investment can do for us as we organize and control our funds, store them up, and set them aside for growth. A lot of people are under the impression that stock markets, capital markets, investment activities are for a certain elite. They're reserved for a certain socioeconomic class. I really would like to address this issue with you and kind of talk to you about what the stock exchange can do for us, the average Rwandan.
Well, Rwanda Stock Exchange is a marketplace in the first place. It's a marketplace for securities. Securities means shares or equities or bonds and any other instruments that may come in future. But in a nutshell, a stock exchange is a place of raising long-term finance, where people raise long-term finance for their businesses, and the general public buys into their business ventures, basically. So all that, the entrepreneur on one side is looking for funds to accomplish their dream, and the investors, which are the savers we are talking about here, you and me, and some other institutions which have some spare money, to invest, they come into those companies and they meet into the stock exchange, or rather the capital market industry, to match their needs. So one, on the other hand, entrepreneur is looking for funds for investing in a long term and accomplish their dream for a profit. Of course, investors are looking for a profit. So the other side has the investors out there, the savers, who are looking to put their money into productive venture. Otherwise, normally we're used to businesses whereby you create your company using your own funds, or you get together with a few people or family businesses. They raise the funding to do their business. However, the stock market is a public place whereby those companies come. Today we have 8 companies which are public and they are listed on Rwanda Stock Exchange. So those companies are doing business as usual. The only difference, they have more investors than a typical family business owned. So on the other hand, we also have some entities, private and government, which use the same market to raise long-term funding for different projects. So for government, they do what we call treasury bonds, whereby people put money. It's like a debt. It's a debt instrument. Government usually issues bonds for people to buy into those bonds. Basically, they are lending the money to the government or any private entity for a certain period of time. So for a bond holder, someone who has invested or who has bought a bond, they are basically buying that bond as an investment for a specific period of time. So it can be between 1 year to 40 years. In America, they do even up to 40 years or 60 years. It depends. In our market today, we have bonds that go all the way to 15 years. So they are between 3 and 15 years. So between government and corporate entities. So in a nutshell, a stock exchange serves to be the medium, the platform where that can happen. entrepreneurs meet investors, and then vice versa.
Most of us, when we start businesses and we need seed funding or we need investment funds, most of us think bank loan
Yes.
in terms of receiving money to start a business.
Or inheritance.
Or that's right. And now the stock market is coming in as an alternative for me to sell ownership or profit share in my business in order for me to raise funds. And that sounds like an interesting alternative. Are there advantages to using the stock market versus other forms of debt?
The benefits are many.
Yeah.
If someone invests in the stock market, you buy your shares, for example, in Bank of Kigali
Yes.
or Bralirwa. Those are the main companies we have,
Yes.
local,
Yes.
because we also have some regional companies. What happens when you are buying shares or bonds into those companies? You stand to gain. The first thing people must think about is a saving. You are saving that money, you are investing in that company. Because most of us, the first thing we do when you get money, we think about spending.
Yes.
So, and when you are there are two choices. You either spend or you save. So spending, you are spending to buy shoes,
Yes.
buy a nice car,
Right.
or go to the salon or a bar with your friends.
Right.
The first thing I was saying is about saving. That money you have not spent it.
Yeah.
Okay, that's number one.
Yes.
Number two, you have put it in an instrument somewhere.
Yeah.
Even if the share price of Rwanda does not go up, that million francs or that 100,000 you have of your own,
Yes.
you put in that company, your shares, you still own them at the end of the year.
That's right.
They are still belonging to you.
That's right.
The same way, you have maybe some land in Gesera.
Right.
Okay? The same land, if you don't sell it, you still have it at the end of the year.
That's right.
Whether the rain falls or it doesn't fall, the land still belongs to you.
That's right.
So now, the saving we are talking about is that one.
Yeah.
You are saving that money because you have invested in a share of a company, or you have lent that money to either government, or you have lent that money to a company which has issued a corporate bond. So now, if you had money like that and you have it in your pocket, most chances are you are going to eat that money.
Yes.
You're going to spend it.
Yes.
However, if you buy it in a property,
Yes.
if you buy it in a share,
Yes.
okay, that
Yes.
money you have saved it.
Yeah.
You put it away. If someone comes to you asking for a favor, can you lend me some money? You tell them, by the way, sorry, I have shares.
Yes.
The last money I had, I bought shares.
Yes.
So you have saved that money.
That's right.
Whereas if you had that money in your pocket,
Right.
you would have feelings.
Right.
You've
You've protected it.
So the money, first of all, you saved it, meaning you have protected it if you
Yes.
bought shares
right.
or if you bought bonds.
That's right.
So now that's number one. Number two, benefit for someone who buys shares, who buys these instruments in the stock market.
Yeah.
The number two benefit is the income coming from that investment.
Yes.
At the end of the day, if a company makes money,
Yes.
at the General Assembly every year they meet,
Yes.
they say, we have made $10 billion.
Right.
Let's divide our dividends according to how we plan.
Yeah.
So some money they save for the company so that
Yes.
they can continue operations in the coming year.
Yes.
But the other money, or they distribute to the shareholders.
Yes.
That's the case of Bralirwa,
Yes.
Bank of Kigali,
Yes.
Equity Bank, and so on and so forth. So that money is given directly to the shareholders who have bought shares in that company on a pro rata basis, meaning that you are given a dividend depending on how many shares you buy in the company. Okay, so now same thing happens for a bond. If you have bought a bond in a government bond,
Yeah.
or if you bought bond over a company so and so,
Yes.
you get what we call interest income at the end of the year.
Yes.
Actually, for government bonds, and most bonds I know, they issue an interest income every 6 months. So you buy a government bond today. Let me give a concrete example.
Yes.
Government bonds we have today on our market, they are between 3 years and 15 years
Yes.
today.
Yes.
So every year they are paying between 11.5% interest income
Yes.
per year
Yes.
and 13.5%, depending on how long you are holding that bond.
Right.
Okay, so that interest you are given, you say, for example, you invest 1 million francs
Right.
in a bond, a
Right.
particular bond.
Right.
So 6 months, they are likely going to give you, if you buy a bond of 11.5%, they are going to give you something like 50,000, in 6 months. And another 50,000, they are going to give it to you at the end of the year.
That's right.
So during that period you are holding the bond, you get interest income
Yes.
twice or once a year,
Yes.
all the way until the period you have agreed. It can be between 3 years, 4, 5, 6, 7 years. It depends on how long the contract you have entered into the government to lend them money, or you entered into the company to lend them money. It's going to expire. So that's how the bonds operate. So the number 2 benefit is interest income or dividend income you get from owning shares in a company or bonds in some institution. So now, number 3, there is something we call capital gain. Capital gain is a gain you get when you buy shares or you buy bonds at a certain price. Then when you go to sell them, okay, you sell them at a higher price than you bought them at. So if you buy your shares at 100 and they go to 150, the 50 francs you are gaining after you sell, minus of course the charges, the commission and so on. So that what you get is what we call capital gain.
If the investor was to hold on to their investment for beyond 3 years, for 5 years, for 10 years, for 15 years, the impact on their investment, they've invested 1 million francs and they wait 10, 15 years to cash out or to sell or to receive the benefit of their investment. Are we not talking about a far greater return over the long term compared to the short term?
In general, it's always better, to wait when you are investing. So, when you think about short term, you're not investing. You are just speculating. You might as well go to a casino
and gamble.
All right, and gamble your money away. So now, the best thing about what you are saying now, when you invest in an instrument for 2, 3, 4, 5 years, people normally get confused about share prices. People look at today, Bradidwa or Microsoft has gone up or gone down and they start panicking. Oh man, we made money today. You have not made money. As long as you have not sold your instruments, you have not made money.
Right.
You understand? Right. So the money is still the same. It's the same thing. If you have a land in Bugesera, the harvest is good this year. The other year it's not good, but the land is still yours. Right. So the same philosophy applies to shares and bonds. So it's always good to keep your investments for the longer period. That's why when we are advising people, we tell them, look at your investment horizon. You cannot have a horizon of 1 day. Horizon already means something somewhere in the future far away. So you are talking about 4, 5, 6, 10 years, 15 years, to look at the real impact of the investment. So now let's go back to the reality. Let's take that 1 million you put in your bond or 10 million francs in a bond, a government bond, or even a share price. Let's assume the share price does not change at all. Okay? Year 1, you get 11%. Year 2, you get 11%. Year 3 and 4 and 5, you get 11%. Okay, let's narrow it down to 10%. It's easier to calculate.
Sure.
Okay? So that investment you have made, even if you don't take that money away, the 1 million francs you are invested, in 5 years' time, you'll have half of that as your net interest income. If you put the 1 million, you will have 500,000 francs, okay, in your account if you don't touch it. That is assuming you have only received the dividend, the income, interest income of 10% every year. So 1 million in 5 years' time, you get back your principal from government or any other institution you have bought the bond from. Then plus the interest you've been earning in those 5 years, that means that another 500 francs. That's 50%. Okay, you have gotten on your investment in 5 years. So now I have seen that without changing anything on it's the basic. That's plain vanilla.
Right.
Okay. So now think about if that interest you keep reinvesting that in a similar or higher or slightly lower kind of instrument.
Right.
So that interest income, the 500,000 you are talking about you would earn at the end of the day, has also been gaining something. So that's what we call compound interest. So now if you invest your money, your interest, you reinvest it. Of course, professionals help you do that. Most of us, we like to do it ourselves in our head. But guess what? It doesn't happen that way. It's better always to use professionals in what we do. So now the power of compound interest is so phenomenal. You cannot believe it. Every 5 to 10 years, you double your money. It's that simple. Without you doing anything, your money is working for you, not the other way around.
so many ways we can benefit from investment income to capital gains to low taxation to having an asset that can act as collateral for loans. Continue to join us every week on Plant Your Seed as we talk about how you can start controlling your income by making use of digital finance. Remember to like and follow us on social media at PYSRwanda as we continue to tackle these very interesting subjects. We'd love to hear your questions and discuss them online and on the show.
Remember, the answer is only the answer. Financial success is living the answer every single day.